Hello and welcome to week 1 of your open book training here at RailTrail. This week you're going to be focused on learning about finance and how that applies to your work here in the business. You'll learn about the key financial statement, the profit and loss, and each of the categories of expenses. You should be thinking about how your job fits into each of the numbers that you'll be learning about as we go through this process. Ready? Let's get started.
All right, let's move on to the real content of the course. What exactly is finance anyway? Well, the dictionary says, finance is how money is used and handled, especially how large amounts of money are used and handled by institutions, governments, and companies. Delta Food Service and Rethink Restaurants think that finance is the most reliable way to measure the strength and health of your business, both over the short and the long term. And of course, there's one other definition. Those would be some fine ants. Just look at those top hats. Before we get into business finance, let's talk about personal finance. How do you use and handle money in your own personal life? Well, you might look at your income, or the money that you take in, and you might look at your expenses. Income might be made up of your paycheck, or paychecks if you have multiple jobs, any interest that you might be bearing from a savings account or other ways. Gifts, maybe it's your birthday this month, if so, happy birthday. And then maybe other income, maybe you have a side hustle or some other form of bringing in money in your personal life. How about the expense side? Well, certainly we all have to pay rent and utilities. We have to eat, food is part of our expenses. We have to get around, our transportation. Healthcare, taking care of ourselves. Entertainment, I hope you have some fun in your life. Probably have to spend some money to do so. Yachts and monocles, however, maybe not so much. What do you notice about these two lists? Write down in your binder at least 2 things that you see and notice from this list. So what did you write down? One thing you might have noticed is that there are more categories on the expenses side than there are on the income side. 2 is you might notice that there were categories at all. We grouped things like entertainment together and utilities. 3, you might have noticed that the income is in green and the expenses are in red. And then finally, you might notice that yachts and monocles aren't really part of your expenses. Now think about this question. How are some of these expenses different from others? Take a moment and see if you can come up with some ideas around that. Write it down, and I'll be back to explain it in just a moment. So one of the differences in these expense categories that we're looking at is that some are fixed and some are variable. For example, your rent is probably a fixed amount. It maybe only changes once or twice a year at most. However, your utilities go up and down. You might spend a lot more on electricity when you're using an air conditioner, or a lot more on gas if you were heating your home. Another difference is the level of control we have. For example, we could choose to eat out at the fanciest of restaurants every night, but that might cost a lot. Or we could eat ramen noodles every day, and that might cost very little. We have a lot of control, to some level, over our food budget. We have little control over our rent throughout the year. We might be able to choose to move to a more or less expensive place, but really we're not moving every month. And in which column do you think saving $100 would be? Think about that as we move to the next slide. Here we're going to take an example personal budget for Bei Mei. Now, to create her budget, we're going to need to do some things. We need to designate a time period. So for how long are we looking at income and expenses? We're going to pick 1 month. So let's take a look at Bei Mei's March 2017 budget in this example. Next, like we did in the previous slide, we're going to group expenses and income into categories. We're going to simplify from the previous slide. Here we're going to use income, food and clothing, entertainment, and etc., along with rent and utilities. Now, we need to know the dollar amount for these categories of income and expense, so here they are. In March, Bei Mei brought in $2,000 of income, spent $400 in food and clothing, $400 in entertainment and etc., and $1,000 in rent and utilities, which left us with $200 in savings. How did we get that? We subtracted all of our expenses from all of our income to find out if we have enough to cover our expenses and if we have any money left over to save or invest. March was a good month for Bei Mei. We had $200 or 10% of our income going towards savings. And there's the equation right there. Now, let's take a look at April. Money's getting a little bit tighter for Bei Mei. Take a moment and see what you've noticed from the previous month. What changed between March and April? Well, you may have noticed that our income went down. Bei Mei used a sick day and took a day off. Food and clothing also went up. Apparently, Bei Mei has a bedazzled yoga pants obsession and couldn't resist a flash sale. Entertainment also went up by $100. April is a month where the weather got a little nicer and Bei Mei wanted to go out and have a little bit more fun. 100%. Also note that rent and utilities stayed the same, as they typically do, or very close. So how did she do this month? Take a moment and subtract all of the expenses from her income to find out whether or not she had any money left over for savings. Well, you might have guessed she had a break-even month. She's no longer saving anything. She's just breaking even. All right, now let's take a look at the third month, the May 2017 Bei Mei budget. A trend is emerging. What do you notice here? Take a minute, look through the numbers, and see what you find. Okay, so income stayed the same. Took another sick day in May. The weather is really nice again. Food and clothing went up another $50, up $100 from just 2 months ago. And entertainment went up $50 again, up $150 from 2 months ago. Rent and utilities continued to stay the same. So how did she do this month? Take a minute, add everything up. She's $100 short. She actually lost money in this May 2017 budget. And it was a good thing that she had $200 in savings from March. Otherwise, Bei Mei might be in some real trouble. So now what? Well, Bei Mei has decided that she's going to get serious about her own personal finances and set a goal for herself. She wants to save $300 a month. What do you think she should do? Take a moment and write down 1 to 3 ideas about how you think Bei Mei could get control of her personal finance and save $300 a month. Do that now. Okay, so we're hoping to turn things around in June, and Beimei has made some changes to do that. First, she's going to pick up an extra shift. So it's a lucrative shift, so we're going to add $100 in income, up from $19.50 the previous month. She also decided to be a little smarter about her food and clothing purchases. She bought food in bulk, saving on the cost per item. She decided to buy not none, but fewer pairs of yoga pants and invested in her own bedazzler, thus reducing the amount of yoga pant bedazzle expense. So she was able to drop her food and clothing expense by $100 this month. She also went out to the club a little bit less and only bought one yacht this month. Well, okay, she didn't buy any yachts this month, but she was able to rein in her entertainment expenses and saved $150 on her budget. And she found a way to trim a little bit off of rent and utilities. She switched her phone services and stopped leaving the lights on all day, every day. So rent and utilities went down by $50. Okay, so how'd she do this month? Take a moment, add it all up, and see if she met her goal. All right, so let's see the result of those changes. She did indeed meet her $300 savings goal. She increased her income, and she more closely managed her expenses in order to do that. It's a $400 swing, actually, from the previous month when we lost $100. Congratulations, Beimei. You're now saving $300 a month. Now you must sustain it. So an overview on personal finance, once again. To track and use our personal finances to guide us, we need to do the following. We need to keep track of all of our income and expenses. If you're looking for tools in your personal life, you might try Mint, which is very popular, or You Need a Budget, both free tools available to help you do this. Then we want to categorize expenses, so we're not looking at a million different transactions, but can rather look at categories and try and move those larger numbers in a positive direction for us. We want to look at similar periods of time, so we might look month to month, or week to week, or year to year. And then we want to look for trends. We saw expenses trending up and income trending down in Beimei's example. And then once we saw those trends, we made some adjustments and got the numbers back into line. And then finally, we want to set some goals. Dollar amounts or percentages that are always measurable so that we can strive to achieve. Do you want to save $100 a month for a new car? $200 a month? Would you like to go on vacation and you need $1,000 to save up? Setting goals helps you achieve them. And finally, a key point about personal finance is that if you're not saving, you're not winning.
So now let's take what we've learned about our personal finances and move them over into a business finance setting. And what you'll find is that they're surprisingly similar. So here we're looking at Beimei's monthly budget over a period, and what we're going to do is take a look instead at Rail Trail's period profit and loss statement. So at the top of Beimei, we've got income. And in a restaurant, we have income too, but we're going to use a different word for that. We're going to call it revenue. Okay, so all the money that we collect and earn from our guests, that's going to be called revenue in our profit and loss statement. Now, in our personal budget, we grouped our expenses into 3 different categories. And that's going to be the case in our business expenses as well. Here we're going to group categories of expenses into, first, cost of goods sold. And cost of goods sold are all of the expenses required to sell our food and drinks to our guests. The next category of expense in a restaurant is direct labor. And direct labor is all of the expenses related to employing the team. As we'll learn later, that includes more than just hourly wages. And then finally, our last category of expense is going to be called overheads. So the easiest way to think about overheads is it's all of the other expenses that aren't related to our food and drink and aren't related to our team. We'll go into more detail on each of these later in this session. So finally, for Beimei, at the end of the month, she had savings or a loss once she subtracted her expenses from her income. In a business, we're going to look at revenue and subtract all of our expenses, and what we're going to come out with is net operating profit, or NOP. And NOP is going to be a critical number for you to understand as you go forward in this program. Net operating profit is how much money we have left from our revenue after we cover all of our expenses. So here are a couple more key points about our profit and loss statement, which is effectively the basic scorecard for the health of our business. First, a simple profit and loss, as you can see, is not so different from a personal budget. We're just using different terminology. Income is now revenue, and we're grouping our categories of expenses into terms that make sense for our business. Now, similar to your personal life, what happens if we have more revenue than our expenses? Well, in that case, we're going to have a positive net operating profit. And if we were to have more expenses than revenue, if we were to spend more than we took in, then we're going to have a negative. We're going to take a loss, which is why it's called profit and loss, as the name of the statement. And finally, if we were to be equal, then of course we would be breaking even. No gain, no loss.
Now we'll start reviewing some vocabulary which we're going to use throughout the duration of this course. You'll have a handout in your binder that will list all of these items, but you'll want to be very familiar with this, as these are terms we're going to use to really speak the language of business finance. Starting with P&L, the profit and loss statement, and the symbol we'll use to describe it. The P&L, as we've just seen, shows the revenue, expenses, and the profit or loss for a stated period of time. It's one of the three main financial statements that are used to manage businesses. And really, it is our basic scorecard. It is telling us, are we winning or are we losing when it comes to operating our restaurant? Next, REV is going to be used as the symbol for revenue. Sometimes we'll refer to that as top line because it's the top line, topmost line, on a profit and loss statement. Revenue is money paid to the business. However, to be revenue, it must be earned. So while we collect meals tax every time we sell a food product, we haven't done anything to earn that money. And in fact, whatever we collect, we just hand back over to the state. Therefore, it's not counted in revenue. Other examples of things not counted in revenue: deposits taken on future catering orders because we've yet to deliver that catering order. When we deliver it, we'll recognize that money as revenue. And then finally, money taken in for gift cards is not yet earned because no one has come in to redeem them. The test for revenue is, have we earned it? If we've earned it, it counts as revenue. The next abbreviation is COGS, C-O-G-S, and that is the symbol for cost of goods sold. You can think of cost of goods sold as the cost of any and all of the ingredients in our food and drink and any necessary packaging. Next, direct labor. Direct labor is symbolized by DL, and this is all of the expenses we incur related to employing the operating team. So that's you, and this will include things like wages, salaries, benefits, taxes, any matching obligations, insurances that we must pay for our having employees, paid by the business. Okay, so you can think of direct labor as the cost of the team, and cost of goods sold as the cost of the items that we sell. And then finally, we actually like to look at cost of goods sold and direct labor together. We'll call them our primary costs. Sometimes that'll be referred to as prime or primes. The reason we call them primary costs is these are the primary expenses that we can manage in the business. Overheads, like we saw with rent, are able to be adjusted, but not at the same level as some of the things like ingredients, portioning, packaging, and the expense of our team. Prime cost, or primes, will be an important concept in this course. Next is overheads. OVHDS is the symbol we use for that. And overhead expenses are basically any and all of the other expenses incurred by operating the business, not included in cost of goods sold or direct labor. We're going to divide overheads into 5 different categories: direct operating expenses, marketing, advertising, and promotion, maintenance and repair, general and administrative, and occupancy. We'll learn more about what goes into each of these categories later on in the course. And then finally, NOP. NOP is the symbol for net operating profit, and you will hear that effectively every week that we work at May in open book classes. NOP is, as we saw, revenue minus primes and overheads, or in other words, all of our expenses, equals NOP. It's what's left over from revenue after we pay all our expenses. The P&L is, as we've said, the basic scorecard for operations. It tells us if we're winning or losing. It's going to give us good feedback on how we're doing in many important ways. And if we look at a series of consecutive P&Ls, it's going to start to show us changes in trends. Think back to Beimay's example, where we saw income going down and expenses going up. That caused us to take action and improve the way that we were performing. We'll also want to look back and compare how we did. For example, how did 2016 compare to 2015? Each period versus the prior period. How did we do in this period versus the period that just passed? Each period versus the same period last year. How did we do in this period versus the same period, or same time of year last? We also want to look forward and forecast and plan. This will be something we'll deal with much later in the course, but is a very important. As we mentioned in the previous slides, a P&L must specify a period of time that we're looking at. Now, most businesses use the calendar month, which is perfectly acceptable for them. However, this is a mistake for restaurants. Can you think about why? Well, let's pose this question. Are all restaurants equally busy every day of the week? Of course not. So which days have the highest revenue here? When are we busiest? How about the lowest? So let's compare January 2016 with January 2017. What do you notice? Well, you might see that January 2016 had an extra Friday and a Saturday, 5 of them. 1, 2, 3, 4, 5. Whereas in 2017, the 5th day fell on a Monday and a Tuesday. Now, I'm sure you know that Friday and Saturday are much busier than Monday or Tuesday in a restaurant. So what might that mean? Now, how about February 2016 versus 2017? Well, in 2016, we actually get an extra day because it was a leap year. Now, how do you compare results when there are these extra days? We've got April with a 5th Saturday and Sunday. May has a 5th Monday, Tuesday, and Wednesday. June has a 5th Thursday and Friday, and these change every year. Here's our solution. Forget about calendar months. We're not going to use them. We'll never be talking about the January or June P&L at May. Instead, we're going to think in weeks, because they always have the same 7 days. What we will do is create a P&L for a perfect 4-week period, meaning that instead of having 12 months of P&Ls, we're going to have 13 periods of 4 weeks each. This way, we can be sure when we're comparing that we always have the same number of days in each period. So in this example, let's do a little math. You can take your calculator or cell phone and use this. Remember that revenue minus all of our expenses gives us our net operating profit. So do a little math and see what you come up with. What's net operating profit in this example? Well, hopefully what you came up with was $50. Let's review the math. $250 plus $400, cost of goods sold and direct labor expense, or our primes, comes out to $650. If we add $300 to that, we've got total expenses of $950. When we subtract $950 from $1,000, that gives us $50 left for net operating profit. Now in this example, we want you to calculate revenue. Do that now with your calculator. How'd you do? Well, hopefully what you came up with was $1,200. The formula works in a number of directions here. So in this example, what you would do is add up all of your expenses. 300 plus 400 is 700, plus another 300 is 1,000. So we had $1,000 in expenses and $200 in net operating profit. By adding all of these numbers together, that will give us revenue. So another formula, or way to look at the formula for net operating profit, would be to reverse it and say expenses plus net operating profit equals revenue. Okay, so now let's calculate the expense of single expense items. What do you come up with for cost of goods sold in this example? Calculate it now. So the answer here is 400. And how did we get that? Well, we took $2,000 in revenue and then subtracted 1,000 plus 400 or 1,400, and then an additional 200 or 1,600. Remember that revenue minus all expenses equals net operating profit, but also that all expenses plus net operating profit equals revenue. So by knowing that we had $2,000 in revenue and $1,600 in expenses and profit, that leaves us $400 in remaining cost of goods sold expense. Now in this example, let's look at not only direct labor, but primes. Calculate the direct labor expense in this example and our prime cost. Do that now. All right, so using that formula again, we're going to come up with $400 in direct labor because 200 in cost of goods sold plus 200 in overheads is 400, plus another 200 in profit is 600, and we need that to add up to 1,000, so the difference here is 400 in direct labor. Then, by adding our prime costs of cost of goods sold and direct labor together, we get $600.
Okay, let's do a little exercise here to see how close your estimates are to the reality of the restaurant world. I'd like you to imagine that you own a restaurant and that restaurant has earned $100,000 in revenue in the past year. Your restaurant is exactly the average restaurant in the country. Financially, you perform exactly like the average national restaurant that is independently owned. What I'd like you to do is pause this video after you hear the explanation of this slide and write down how much of that $100,000 you think you spent on cost of goods sold, direct labor, and overheads, and then how much is left for net operating profit. So of that $100,000, you're going to break that into 4 different parts. 1 part for cost of goods, 1 part for direct labor, 1 part for overheads, and 1 part for net operating profit. When you advance to the next slide, you'll start to learn a little bit more about what a national average restaurant does on financial performance on a yearly basis.
So here's your answer. The National Restaurant Association does research every year and found that in this past year, the average independent American casual dining restaurant, which is the category that May fits into, achieved a net operating profit of about 5.6%. It hovers around 5% annually, some years being higher, some years being lower. How close were you to 5% profit? Is that surprisingly small for you? Think about that. For every $1,000 in revenue that we bring in, think of all the items that we must sell in order to achieve $1,000. We're only bringing in 5% profit, or $50 on that 1,000. Pretty crazy, right? Now let's look at the benchmarks. How did you break up your expenses? Well, the way that we look at our expenses in percentages, we want prime costs, or cost of goods sold and direct labor, to not exceed 60% of our revenue. Okay? Again, cost of goods sold plus direct labor, we want them to be at 60% of revenue or less. And we get worried when they're less than 55%. We'll learn more later in the class, but there are different types of profit that can be created. Good profit is when we efficiently manage our expenses and control our costs. Bad profit can come from overworking the team or using lower quality ingredients. For example, if we moved away from our local sourcing philosophy, we might be able to save on ingredient costs, but would in turn be sacrificing something very important to our concept. Overheads should not exceed 30% of our revenue, which would then leave 10% of net operating profit. Now, we consider 10% to be basic health for a restaurant. By generating 10% profit, we can refresh our facilities, invest in growth initiatives, and use that profit to create a healthy long-term business. 10% is good. 10% also allows us to share profits with the team. But to go from good to great, which is what we're up to here in Open Book, we need to do some things. We want to keep our primes between 55 and 60%, so lower than 60 is better. We want to control our overheads. And then as we grow revenue, our net operating profit can grow to 15 to 18%. We may not get there in this year, the first year of Open Book, but that target is well within reach for you, the team at Maybe. Now let's look at some examples and start talking about why percentages are so important when we look at profit and loss statements. Here, we're going to take a look at Ray Ray's Pizza, period 3, or P3, that's how we'll abbreviate it, profit and loss statement. P3 means it's the third accounting period this year, or weeks 9 through 12 of the year. So Ray Ray had revenue of 1,000, cost of goods and direct labor and overheads all at 300, with a net operating profit of 100. There's Ray Ray. He's feeling pretty good about that. And how does this look to you? Is that a good performance? Well, based on what we just looked at, I think your answer should be yes. We kept our primes at 60%, at $600 of $1,000. Overheads were controlled at 30%, or $300 of $1,000, and we achieved our 10% benchmark NOP of $100 in profit on $1,000 in revenue. Now, next period is into April, and things pick up a little bit in the restaurant industry in the spring, so yes, he expects to make a lot more dough. Now let's look at these two periodic P&Ls side by side. Here we have the period that we just looked at, period 3, and here's period 4. Take about 1 to 3 minutes and write down some observations that you see. What do you notice as we go from period 3 to period 4? When you're ready, you may restart the video. Now, what you may have noticed is that Ray has had some changes here. Revenue went up significantly, 100% increase actually, from 1,000 to 2,000. Cost of goods also went up, but did it go up at the same rate? It did not. Cost of goods increased more than double. If it had doubled, this would have been 600, and instead we're here at 700. And it's the same story with direct labor. Direct labor increased at a more than double rate. Overheads, however, we increased at less than double. So we only went up by $140 here instead of going up to $600. And our net operating profit, while it grew, did not grow at the same rate as our revenue and some of our expenses. This is why looking at percentages is so important on a profit and loss statement. The dollar amount alone for each category doesn't always or easily tell us the whole story. When we look at the percentage of revenue for our expenses and net operating profit, we see how much of the revenue pie they take up. And there's a Ray pie. So when we think about revenue, it's always going to be 100%, because when we use percentages, it's about percent of revenue. So revenue is always 100% of itself. But when we think about expenses and net operating profit, that's when we start up slicing the pie. So, for example, COGS in period 3 was 30%, and there's a 30% slice. Then we've got another 30% for direct labor, and then a final 30% for overheads, leaving us 10% for net operating profit, or NOP. And it gives us valuable context for the dollar amounts. We're going to look at both dollar amounts and percentages when we look at P&Ls. And then finally, by looking at percentages, it's going to help us know if we're doing well, are we tracking the way that we want to be, or do we need to look at improving in certain categories. So, back to that period 3 P&L, here are our percentages and how you get them. In order to calculate a percentage, you simply divide each item, the expense dollars or the NOP dollars, by revenue. So in this case, it's $300 divided by 1,000. You may do that on your phone now. And what you'll get is 30% for the 3 expense categories and 10% for net operating profit. All of the expenses and net operating profit percentages should add up to 100%. This is a good way to check your work and make sure that you've got the right numbers. Now, in some cases, we'll look at decimal points, so 30.1% or 29.9. Because of rounding, sometimes you will end up adding up to 99.9 or 100.1%. This is acceptable and not something we need to worry about. If you see that, you're still correct. Now, in the case of negative net operating profit, like we have here, we're still going to see percentages add up to 100, and we're still going to see the dollar amounts add up to dollars of revenue. So, for example, we've managed to achieve 30% cost of goods and 30% overheads, but in this period for Ray, direct labor was very high. We spent $500 or 50% of our revenue. Now, if we add up 30 plus 50, that gives us 80, plus another 30 gives us 110. But then we add a negative. Negative 10% plus 110% equals 100%. And the same is going to be true with our dollars. 300 plus 500 is 800, plus 300 is 1100, plus a negative 100 gives us $1,000 in revenue. Remember that expense dollars and expense percentages taken with NOP dollars and NOP percentages will always add up to revenue if your numbers are correct. Now, if revenue doubled to 2,000, how would you expect the dollars of cost of goods to change? And what would you think the percentage change might be? Well, we've learned in previous classes that as revenue increases, we expect cost of goods to increase at a similar ratio. So we would expect for a $2,000 revenue period for Ray that cost of goods would double from 300 to 600. How do you think each might change for direct labor? Well, direct labor is sort of like cost of goods, but not exactly. We can't add a third of a person to a shift. We might be able to add minimal hours, but direct labor sort of functions like a step function. As we grow more revenue, we can serve that revenue with our existing staff, but at a certain point, if we're busy enough, we need to add a third person on the line, another server, another person at the counter. So direct labor will change in what we call a step function. It will remain the same at a certain level of revenue until we achieve enough revenue for it to grow by one person or one set of hours. And then finally, overheads. Overheads change the least. This is where growing revenue can be a real advantage for our business. As we sell more of our items, we don't have to necessarily pay more in rent, perhaps marginally more in utilities, certainly no more in insurance. This is the power of growing revenue. New revenue, once we've covered all of our expenses, becomes much more profitable than revenue before we've covered our expenses. And net operating profit. Well, as we double our revenue and cost of goods increases at a similar rate, our direct labor may or may not increase, and overheads become less of a percentage and don't increase at the same rate, we would expect net operating percentage to grow at a rate greater than our revenue gains. So we would see the percentages increase and the dollar amounts increase for net operating profit. And how about if revenue drops by half? Well, now you just take everything and inverse it. Cost of goods would decrease at the same rate. If we effectively manage our labor, labor might decrease as well, although there are a minimum number of people we need on a shift. That's why really slow days can be a drag on restaurant profitability. If we need 2 or 3 people and we only sell $100 of revenue items in that day, that is a very unprofitable day. And of course, overheads also need to be paid. So rent doesn't change whether we sell $1,000 in a day or $0 in a day. Overheads are an advantage for us when we're growing revenue, but a big disadvantage when revenue falls. So now let's look again at period 3 and period 4 P&Ls. Pause the video and write down 3 observations that you can make from what happened between these 2 periods for Ray Ray's Pizza. So what did you come up with? Well, as we can see, the slices of the revenue pie have changed. Cost of goods is now 35% instead of 30%, and the same is true of direct labor. As we discussed, overheads did not increase at the same rate, so our percentage of revenue for overheads is now 8% lower, or 22% of the total. However, taken in whole, we've actually decreased our net operating profit, the opposite of what we would have expected to happen, from 10% to 8%. While the dollars of net operating profit went up by 60, our percentage of revenue profit changed. What I would suggest here is that cost of goods sold and direct labor got out of control as Ray Ray's got busy. And unfortunately, our prime cost in period 4 added up to 70%, or 10% above what our benchmarks are. If we were the owners of this business or managers of this business, we would be concerned and really go after cost of goods and direct labor to make sure that they're being well managed, so that as we have better revenue months or periods in the future, we're able to capture a bigger percentage of net operating profit. So a question for you. Do you think profit is a dirty word? If you do, you're not alone, and it's really easy to understand why. Have you seen something in the news this week, in the last 7 days, something negative that a corporation or business has done for the world, society, their employees, the environment? The answer is likely yes, and we're inundated with stories like that on a regular basis. So since the 1970s, corporate America has operated in pretty much the same way. As you see here, memo to directors and corporate executives, your sole duty is to maximize profit for the investors. Now, this line of thinking comes from economist Milton Friedman, who's sort of the founder of this Chicago School of Economics line of thought. The Chicago School of Economics and Milton Friedman say that the most important thing is maximizing shareholder value. So maximizing the value that is generated by the owners or shareholders of a business. The way that manifests, unfortunately, especially in combination with Wall Street, is that corporate executives and CEOs who have millions to tens of millions of dollars at stake in terms of bonuses will do whatever they can to maximize short-term profit. They may choose not to pay for environmental cleanup or regulatory adherence. They may choose to underpay or lay off unnecessarily their workforce. They may short shrift the customers that they serve. All this in the order and in the name of maximizing profit for investors. We call this shareholder primacy, meaning that the needs of the shareholders or owners of the business takes precedence over anything and everything else. But let me ask you, does that mean that we should just screw everyone else? In our business, of course, the answer is no. Unfortunately, in many corporate businesses, the answer is a resounding yes. Now let's ask this question. Do you think it's okay to hide evidence that our product is really bad for its consumers? I'm assuming since you work at Maymay that the answer, again, is a resounding no. However, the tobacco industry said absolutely yes. Here you'll see an ad for Lucky Strike cigarettes that lists over 20,000 physicians saying that Lucky Strikes are less irritating. It's toasted and gives you throat protection against irritation and against cough. I think we all know that the tobacco industry misled consumers for decades, paid millions upon billions of dollars to hide the results and effects of their products, leaving consumers undereducated and creating a lung cancer epidemic in the United States. This is an example of serving the shareholders and not caring about anybody else. Now ask yourself, does the pursuit of profit justify any of these things? Is it okay to pollute the environment so that we can generate more profit? What about carelessly laying off our employees or endangering employee or consumer health? How about finding ways to escape any taxation at all? Again, presumably your answer to these are no, and that's certainly what we believe as well. And unfortunately, the news is full of examples. So here you see two such examples. One is the Upper Crust Pizzeria, a local Boston pizza chain that was in the news a number of years ago for its labor practices. The story there is that when the business was opening, the ownership found a village in Brazil and promised wages and good jobs and security for people who came from that village to work for them. What they delivered instead of that promise, however, were jobs that did not pay overtime. They categorized everybody, including dishwashers, as managers so that they would escape having to pay overtime wages to their employees. The Department of Labor found out about this and fined by hundreds of thousands of dollars the owners of the business. The next day, the owner brought in his employees who were participating in the suit and let them know that he would be paying their wages, the back wages as directed by the Department of Labor. But however, they would be working off every dollar that he was going to pay them in hourly wage. Yes, that's right. On the same day, the owner went out and purchased a yacht and a boat for himself. Pretty messed up story. As it turns out, the Department of Labor got wind of this and sued the business again, which ultimately led to the closure of many of its units. A Harvard professor organized some of the employees who had been named in the lawsuit and organized a purchase of some of the units for them. So if you see the Just Crust, that is a employee-owned business owned by people who were taken advantage of by the previous ownership. You might also have heard about Volkswagen a few years ago. Volkswagen intentionally designed its car computers to mislead emissions testing. Now we have tens of thousands of vehicles on the road that do not meet emission standards, that are polluting the environment at a level above which all of our regulatory agencies have said is acceptable. However, Volkswagen did not have to recall or fix these vehicles, but instead paid a significant fine and continues to do so. These are just two examples of corporations, local and multinational, acting on the pursuit of profit, but not doing so responsibly. Now, this news coming out as regularly as it does can be very overwhelming for us. But does that mean that profit is inherently bad itself? Have you ever heard the phrase, money is the root of all evil? Did you know that the actual phrase is the love of money is the root of all evil? Money, or profit in this case, is simply a mechanism, a piece of paper or an electronic digit that we agree has a shared value. If I give you a $20 bill, we both agree that that piece of paper is worth $20 and can be exchanged for $20 worth of goods and services. The paper itself is not bad. However, our intention and what we plan to do with that piece of paper or monetary value can be. So profit can be used for good or bad. It depends on how you run your business, what your value structure are, and what you believe profit is. So take a minute here and do a few things. One, I'd like you to write down at least 5 things that you think profit could be used for that is good. What do you believe is good profit? Do that now, and when you complete that, read your handout from Phil Knight, the founder of Nike. When you're ready, advance to the next slide. So, profitable businesses responsibly run do the following. We contribute to the lives of the people involved. We build skills and experience on our team. We provide secure jobs. And we enhance the quality of life in our community. This is what a responsible business does, and one that is profitable can do more of it. So how do we know that we're creating good profit? Well, one example comes from Fred Reichheld, who wrote The Ultimate Question, which is often called one of the 20 most important books ever written about business. You may have taken a survey in your life where you've seen this question right here. Would you recommend our business to your friends and associates on a scale of 1 to 10? This is one of the most well-researched questions in the industry, restaurants, and in business in general. It tells us that when our customers or our guests give us a 9 or 10, we have thrilled them and have created a wonderful sense of experience when they join us to dine. So these guests are so happy that they may become regulars. Regulars, as we may know already, come back to us again and again. We might know their name, and are really one of the best ways to build long-term revenue in a restaurant. Having regular guests who visit us on a regular basis is one way that we can create solid revenues and solid profits. And in fact, some of those regulars become so close to us that they become what we call advocates. We'll talk more about regulars and advocates later when we talk about building revenue in our business. And advocates are very important. They're in fact perhaps the most effective form of marketing for any restaurant. Advocates are the type of people that will hear someone down the hall talking about which restaurant they should go to, get up from what they're doing, and go over and talk about how great an experience they had at May and why that person should join us for dinner, lunch, or some sort of catering event. Advocates are members of our team without actually being employed by us. And again, though we're now in a world of social media recommendations and Yelp, word of mouth is, and we believe will always be, one of, if not the most important marketing tool in the toolbox for food service businesses and in particular restaurants. Now, if our customers are happy, that doesn't necessarily mean we're creating good profit. At least that's what John Case says. He says that's not enough. John Case, pictured here, is a former editor at Inc. magazine, INC magazine, which is one of the preeminent business magazines in the country. John is also a Cambridge resident and a colleague of us here at Rethink Restaurants. You'll see in your handout that John says if the customers are happy, but we're abusing our employees in some way, or the environment is being polluted, or we're not keeping our agreements or our covenants with our vendors, or if we're not paying our fair share of taxes, then guess what? we still don't have good profit. It can't just be about our guests. It has to be about more than that. Take a moment and read through the handout from John Case that you have in your binder, and when you're ready, advance to the next slide. So if we don't advocate for the shareholder model of capitalism or the shareholder primacy that comes with it, what do we advocate for? Well, what you'll see here is a visual element of the stakeholder model. And we see good profit being achieved only if all of the stakeholder interests are respected. Now, that doesn't mean that they can all be served, but a responsible business that cares about creating good profit, that's us right here, will consider the needs of all of these different elements around us. These are what we call stakeholders. And what that means is that each group here has a stake in the way that we operate our business. Our employees, the community, our vendors, the environment, the owners and investors, and the customers. Now, sometimes we might have a situation where the needs are not necessarily aligned. Take, for example, Caden's Cabbage Company, one of our cabbage vendors. Caden's Cabbage says, hey, things have gone really rough out in the fields this year. The weather has been tough. We're going to need to ask for $1 more per head of cabbage. Now, the business could absorb that cost, and employees might not be able to enjoy as much profit sharing, and owners may not be able to receive a dividend this year. Or alternatively, we could raise the price of the items that we use cabbage in, and perhaps our customers would be affected by that. We might also look at creating a more efficient or new recipe to use that cabbage. However, that might create work for our employees that we weren't prepared for and didn't plan for. It could create stress on the team. We could go back to the vendor and try and renegotiate or find a new vendor. But as you know, Maymay is very committed to our local sourcing strategy and the local farms with which we do business. There is no right answer here. In this situation, someone on the other side is going to have to deal with something that is not perhaps ideal. But a responsible business thinks about all of these elements and says, what can we do that's best for all of us, and allows the business to continue to be successful and generate profit so that we can continue to serve all of our stakeholders. So how does this relate to what we do here? Well, we're going to talk a lot about profit and a lot about different ways to generate more of it. But here's the thing. The first question we must ask before we make any improvements or any changes to our business is, are we creating good profit? If we're not, then we ought not do that thing. We will always be thinking about our stakeholder model as we try and improve the profitability of our business. This point feels important to relay to the team at Maymay. You're here because you share values that are in line with our business. You probably believe that local food and the food system itself is an important thing to invest in and repair and improve. We do as well. In order to do that, we need a profitable business so that we can better respect and treat all of the employees, the community, the vendors, our guests, the owners and investors, and the environment with the respect and care that we wish. Our question will always be, are we creating good profit? You have a handout worksheet where you have a number of items listed. Please take the next few minutes and write down what you think each item would be. Is it good profit? Is it bad profit? And if it depends, put a question mark and note that, because sometimes it's not black or white. When you're ready, proceed to the next slide. So what happens to profit in a small business like ours when it's created? Here you'll see that in this example, $184,000 of net operating profit was created. This giant bag of money right here. Now, what do we think happens to it? Does it go into the pockets of corporate fat cats? Like this one? Or maybe this one? This guy over here? Who knows? The answer, of course, is no. There's quite a bit that needs to happen with our business before we can even think about taking distributions to the owners. So how many uses of profit can you think of? Take a moment, pause the video, and write down at least 3 different uses of profit you think a business might incur. When you're ready, press play and continue. So we look at uses of profit in 8 distinct categories. We're going to walk through each of those right now. The first one is to service debt, if any exists in the business. Debt can be in the form of loan payments, if we took out a bank loan in order to open up our business or expand it. And when we pay that back, just like we would a mortgage, we're paying both principal and the interest accrued on that debt. The interest portion is something that we consider an expense, whereas the principal portion is a use of profit. Now, why is that? Well, if you took a $100,000 loan out from the bank for 10 years and paid back all $100,000 of it within the 10 years, at the end of the day, you took $100,000 and then you paid back $100,000. But you also paid more. Just like any loan or credit card, you're paying interest on the principal of what you borrowed. That's why the principal portion shows as a use of profit, whereas the interest portion is an operating expense. It's an expense incurred in order to obtain the funds we needed to grow or establish our business. Another use of profit is to replace or add capital equipment. FF&E, which you'll see right here, is an abbreviation for factory, facilities, and equipment. Now, here are some examples of something that might be a capital expense: a 3-bay sink, a couple of ovens here. Now, the way that we look at capital expenses versus a normal purchase is twofold and is guided by accounting principles. The first lens that we look at is how long will we use this piece of equipment. If it's greater than a year, it tends to fall into the capital equipment category. Also, how much did the equipment cost? Typically, a business will use a rule of $500 or $1,000, and if a piece of equipment costs more than that, it is a piece of capital equipment. This is different from small wares, dishes, things like that, that will show up in our operating profit and loss statement. Capital expenses, like what you see here, will not show up on our operating expenses and are considered a use of profit. Next is to refresh or improve our facilities. Restaurants in particular need to pay attention to this. Having the same interior design, the same look and feel over time can result in our restaurant becoming a little bit tired and perhaps off trend or not as exciting for our guests. We always want to be thinking about ways to refresh, improve, and beautify our space so that we're always on the cutting edge of look and feel and on brand for Maymay. The next is to invest in growth. So this might be funding a new business venture, expanding an existing business venture, looking at adding seats or taking over a new space, adding an additional truck, things like this. Basically taking profit and reinvesting it back into our business so that we may grow our revenues and then presumably our profitability. Next is a big part of this open book process altogether, and that is to reward our team's performance through profit sharing. Profit sharing is not an operating expense since it's derived from the profit that we, the team, create, and therefore is considered a use of profit. The next is to add to the cash reserve, or if it were a personal finance, the piggy bank, the savings account. Businesses, especially restaurants, tend to have slower periods of time. Winter can be particularly challenging in our market. So having cash in the bank to cover our expenses, should we incur them and not have operating profit to pay them, is a wise business decision. Healthy businesses have at least 1 month of operating expenses in the bank. Next is to pay our fair share of taxes on our profits. Nominal rates, or the listed rates for tax between federal and state, tend to run between 25 and 35%. We pay these taxes on profit after we've paid for all the other operating expenses and then used some of that profit for some of the items that you see above. We'll get more into that in just a moment. And then finally, distributions to the owners, or ROI, which stands for Return on Investment. Notice that this is last on the list, and that is the way that it manifests in most, if not all, small businesses, or at least ones that are responsibly run. Owners ought not take funds out of the business unless we've fully addressed all of these other uses of profit issues. Now, as we mentioned a couple of slides ago, there are some tax advantages to uses of profit, and we'll talk about them now. We pay income taxes based on not the operating profit, but on the total net profit that our business generates over the course of the year. When we replace or add capital equipment, when we improve or refresh our facilities, when we invest in growth initiatives, or when we share back profit with the team, that reduces our net profit in the eyes of the government. We've spent that money, and while not an operating expense, we did spend it, and therefore our profit has been reduced. And as we reduce our profit, the percentage that we pay on taxes, while it may stay the same, it will reduce our overall nominal tax bill. So, is that just some easy way around the tax laws? Not really. There's a benefit to the economy to all four of these items. When we replace or add capital equipment, we're purchasing from other businesses, increasing their sales. When we refresh or improve facilities, we might hire contractors or artisans to help us do that. When we invest in growth, we're creating an opportunity to generate more revenues in the long term and create new employment opportunities in our market. And then, of course, when we share our profits with our team, that's money that will likely then get spent back in the local economy, creating more economic activity. Now we're going to move on to take a closer look at our expense categories, starting with COGS, or cost of goods sold. And we're going to use a personal example. Let's say that you just moved, which who knows, could just have happened, and that you went out and bought $80 worth of groceries for your poor empty refrigerator. Some chicken, some olive oil, some veggies, and so on. Yes, all the foods. Healthy options up until just now, it looks like. Yes, that fourth ramen noodle. Now, at the end of the week, let's say that you've made a dent in a lot of the things, but you've got some stuff left over. I mean, surely you didn't use all of the olive oil or butter. You bought an extra large portion of ramen, so you've still got some of those around, and some of your fruits and vegetables are still around as well. So the value of these remaining groceries is going to be $30. You spent $80 and you've got $30 left. Now, it may stand to reason that your real expense was $50, not $80. Why? Because you spent $80, but you didn't yet use all of the food. What you used was $50 worth of your grocery bill, and that was your real expense for that week. And that's where we derive our formula to understand the real or actual cost of goods at our restaurant. It's purchases minus the ending inventory is equal to the true cost. Now, this assumes that we start with nothing in inventory. Now, what about next week? You still had $30 worth of groceries, right? Our olive oil, our fruits, veggies, our eggs, so on. Now you buy $50 more. You're not sure about the dollar value of what you ate up, but at the end, you have $20 of food remaining. Okay, so let's take a look at that. So now we've got one additional item in our formula. Our starting inventory, which was $30 of groceries at the beginning of the week, plus our purchases, which again was $50 this week, minus our ending inventory. So $20 is what food we had on hand at the end of the week, meaning that our true cost of food, or cost of goods sold for the week, was $60. 30 plus 50 is 80, minus 20 gives us 60. So stepping back from the math, it makes sense. What we really care about is how much we used during a given period of time. And when we're looking at COGS, just like we are with all of our finances, we're going to be looking at them on a periodic basis, so every 4 weeks. So what we really want to know in the restaurant is, what did it cost us to sell all of the menu items from a cost of goods sold perspective over a 4-week period? And to do that, we need to know what the starting and ending inventory was, as well as the cost of all of our purchases. Now let's take a closer look at direct labor. Let's say you make $12 an hour. Is that what you take home? Of course not. You've got payroll deductions, so you might take home something like $10.18 for every hour that you work. And that bite out of the apple, so to speak, are taxes that you're paying to the state and the federal government. Now, did you know that an employer has many different taxes they incur, such as a FICA match, unemployment, federal unemployment, workers' compensation insurance, and from $12 an hour, that's $10.18 for you, and it costs the restaurant or our business about $13.68 for every hour worked. So in addition to your paying your share of the taxes, the business is also incurring what we call payroll taxes in order to employ you in our business. Yes, more bites out of the apple. So what else is included in direct labor? Well, we basically think about this category as whatever the expenses are that are required to employ the team. So benefits like health insurance, staff meals, wages for training are included in our direct labor expense. Think about this. Where could we find some good profit in reducing our direct labor expense? One area might be improving the way that we onboard or train new employees. Being more efficient and getting someone on the floor reduces the overall expense to train new employees. And then, of course, there's the cost of turnover. Bringing new people in who don't know quite our systems or aren't up to speed with a veteran takes time and potentially requires us to schedule more hours than we would need if we had a fully trained team. There's an opportunity here to look at optimizing our direct labor expense by improving these different pieces of our personnel management. Next, we're going to take a closer look at our overhead categories. We break down overheads into 5 distinct subcategories: direct operating expenses, marketing, advertising, and promotion, general and administrative, maintenance and repairs, and then finally, occupancy. Direct operating expenses captures all of the expenses that are required to operate a restaurant, not categorized in direct labor or cost of goods sold. Things like glassware, flatware, supplies, kitchen propane or gas, laundry, linens, security, point of sale. All the different operating expenses that are specific to our type of business are likely to appear here. Are there some opportunities here? I think that we'll discover as we go through this process that there are. Being more efficient with linens is one that we see at many of our client businesses. Next, let's look at marketing, advertising, and promotion. This is a pretty straightforward category from its name, but it's basically all of the expenses we incur to market, advertise, or promote our business. Things included here will be menu printing, media and print advertising, any design fees, promotions, coupons, delivery service, guest comps, promotional events, and then contributions and donations. Next is general and administrative expenses. Here, we're going to find operating expenses that apply to all different types of businesses, not just a restaurant. So administration fees like fees from our bank or merchant fees, payroll processing fees, dues and subscriptions, insurance, interest expense, a number of different professional fees, automobile, travel, cable, internet, all this good stuff. All the stuff that any business might experience in operations are going to fall here. And then, of course, we do capture executive management salaries and benefits so that when someone's not doing a direct shift but might be a manager or an executive for the business, their expense is captured in this category. And one of the opportunities that we see at many of our clients is looking at payroll processing and related expenses. They can be very expensive if not well managed. Next is maintenance and repairs. Here we're going to find all of the expenses related to maintaining and repairing our equipment. That might include services like grease trap, cleaning supplies, pest control, and of course the repairs themselves. Now, what we often find is that emergency repairs, as we've discussed in class, are very expensive and very disruptive. So what we really want to do is focus most of our expense in this category on scheduled preventative maintenance to avoid these emergency repairs, which can be very costly. And then finally, occupancy, which tends to be the least controllable of our overhead categories. This is going to include all of the expenses related to occupying our space. So that might be rent, parking spaces, any common maintenance fees that we pay. We have a share of real estate taxes that are due, and then the utilities that we use in order to operate the space. There's some control here in the utilities that we can exercise, but for the most part, what we're looking at is pre-negotiated fees that are going to be incurred no matter what we do.